Hey everybody, Chris Luther here with the Chris Luther Real Estate team at eXp Realty and joined today by Kevin Miller. Kevin is one of our preferred loan officers over at Fairway Mortgage. So wanted to get Kevin on the call. Today it's October 26th, so the year is winding down, but wanted to bring Kevin in and, we're getting a lot of questions about mortgages, rates, where the market's going to go, things like that. So just kind of wanted to do a little video here to kind of put some information out there that maybe will help educate some of the buyers out there and sellers of what's going on in the market and how we can help. And so, with that being said, Kevin, welcome, and glad to have you here today.
Oh, thanks, Chris. I appreciate you having me on and look forward to chatting with you and hopefully answering some questions for some folks.
Absolutely. Well, we're going to kind of dive right in and just kind of talk about, some of the things that we're seeing and people are asking. So, I guess first and foremost, I mean, nobody has a crystal ball, but if you look out into the future, obviously we're kind of end of the year here and, not a whole lot going on November, December. Everybody's getting into holiday mode, so certainly understand that. But as we start to turn the page, mentally to January, which is typically kind of when we kick off our spring season because our weather's so nice year round here. Do you see anything, I guess, economically or otherwise that, is going to, create a lower rate environment? I mean, right now everybody's, a little bit spooked with the rates where we're at a 23-year, high. So certainly understand us getting those questions and trying to calm people's fears, but we also want to make sure that we're giving accurate information. So in your world, what are you guys looking at? What do you see on the horizon that may affect rates one way or the other? Or, what are you seeing?
Well, obviously, anyone that's watched the news and sees everything that's going on understands a lot of this is the federal government being involved and inflation. We all know that, or, pay more at the pump, pay more at the grocery store, everything else. And doing a lot and selling mortgage-backed securities and things like that that are influencing the market, and trying to trend it in the way that their target goals to hit their target goals. So as far as in the future, as far as moving into 2024, we look at those things and we're realizing, okay, the inflation information is leveling off. It's, not quite where the Fed wants it to be, but it is definitely better than it was a year ago and continues to improve. So the market stabilizing from that perspective, the market's not being flooded with mortgage-backed securities in the behind the scenes is going to play an impact in 2024. That's definitely something we're keeping an eye on and watching those trends, and they're trending. Obviously, there are some anomalies, right? We had there's a global issue going on right now with Israel and all the things that are happening there. You can't dictate what those are going to bring to the world as well. But the inflation stabilizing and getting nearer to the target markets for the Fed is going to be a huge benefit to the direction that rates will go in 2024. Secondly, that and presidential election. Historically, presidential elections will always impact the mortgage market 90% of the time for the better, because whatever political party is in power is looking for the economy to look good, so they vote for them, and whoever's trying to take over is doing what they are, saying what they're going to say for them, for their terms in order to improve the markets and improve the economy. So both of those factors will hit in 2024. The timeline of it, again, like you said, I wish I had the crystal ball. I wish I could tell you
Yeah.
it's going to be January 1 or it's going to be February 2nd, but it could be, second quarter of 2024, it could be sooner, it could be later, but there are things in place and directions are heading in the right or going in the right direction for us to see improved market conditions over time.
Yeah. And I think, we have a lot of buyers sitting on the sidelines in hopes that rates will come down. And yes, we all hope that they will come down, making housing more affordable. That certainly is the goal. But I think there's more to it obviously than rates. We don't have that crystal ball, but I think, even if we do see a dip in rates, would you agree that we're not going to see anything significant in the next year?
Again, yeah, I mean, even if it is significant, here's the thing to think about. Even if rates reduce, significantly, let's just say they go down 2%, anybody that was in market looking for a home during COVID, think about those times, think about what that means. Your rates reduced and your inventory is still low. So now you're competing against a huge number of buyers now that are coming out of the woodwork that are now going to, be coming after that same house. And if you're not putting $5,000 over, and guess what? The sellers are going to increase those purchase prices, just like we saw during. I mean, you could speak to that data better than I. How much did we see those those houses going up in sales price in a
Well, and
short
that's the
period?
thing. It all comes back to supply and demand. I mean, and to your point, if we've got a lot of people right now that would like to buy a home, but feel like they'd like to wait for those rates to come down. But think about, if you're out there thinking that thought, how many other people having the same thought? Because what happens is, everybody's sitting on the sideline waiting. And then what happens is when we do get that drop, whether it's a point or whatever it is, then
Mhm.
guess what? Then all those people that were waiting are going to come back. Well, what do you think that is going to create? It's going to create demand for
Mhm.
those limited amount of housing we can, because we're not going to change that inventory mark, because these people that have 2 and 3% rates right now are not going to change they're not going to get out of that and trade that for even a 5 or 6% mortgage unless they have to move. So that inventory issue is going to continue to be a factor. And I think, there's there's a lot of talk about, new home construction and whatnot. And I think that's going to have to be somewhat the answer for any kind of relief, but they're not going to be able to build them fast enough
Nope.
to really make a dent in the shortage that we have. So
Yeah.
that's certainly,
And
one of the factors.
getting into the home now, and beginning to build some equity, because again, you and I have talked before about, okay, if you bought that house 2 years ago, what is it worth now? Versus waiting and saying, oh, the rate's better, but if I'm paying $50,000 more for the same house, is it does the numbers really make sense? We're seeing that increase. You can refinance the terms later. That's always an
Right.
option. But you can't get the house at the same price.
Yeah, so let's talk about that particular buyer, because we wanted to address a few situations today. So let's talk about that buyer that right now can actually afford and qualify for that mortgage with the higher rate. Yes, that's not the rate that they necessarily want, but if they can qualify and they can stomach, that for right now,
Right.
how do we set that person up for success with the current market to kind of, you know, make sure that they're getting the house that they want, but
Mhm.
also not waiting to where it may cost them more to wait and they're not realizing it, as opposed to going ahead and buying it now. So what can you how would you speak to those folks that come in that are in that situation?
I think you're absolutely right. It is about, can you afford the payment? Can your family afford the payment? Yes, is it a great number? No, it's not the number you want to see. But when you start talking about every $10,000 a month that you go up in a purchase price costing $50 more on the payment, well, fast forward and you're paying 50, 75, $100,000 more for the same house if you wait long enough. You really negate any of the benefit that you have. Now, in the meantime, if you get the property, at its current position, at its current, level, you're getting into the house. Yes, you're paying a little more interest during that time frame, but when that rate comes back, that number is going to continue to go down. But on the opposite coin, your house value is going to continue to go up. So it's kind of like you're bridging this gap. And it does come down to, can you afford it? Are you putting yourself in a financial position that, because a home is an investment. It is,
Yeah.
you just like investing in stocks or bonds or anything else, really, you can look at it that way. But Chris, what are we seeing right now in appreciation? Right, on average.
Well, I mean, if you look at the last 2 years, which I mean, there's certainly some anomalies as you spoke of. I mean, we're looking at, the last 2 years have been, in certain pockets, 10 to 12%. A normal appreciation market is usually about 2 to 3%.
Right.
Well, for the last 3 years, we've been way well above that. And so to your point on that, the part of the equation I think with the buyer that's often missed is they get so caught up in the rates where they say, okay, well, if I can wait for it to come down a point or point and a half, here's how much I'm going to save, or how much more home I can afford. I get that there's two different buyers there, but I would turn it and say, but by waiting, how much equity right now, because we're seeing so much equity gap in terms of your house that you buy for 300,000, which is hard enough as it is right here, but you buy a house today for 300,000. Well, if these trends continue, you're looking at that house in a year being worth 330,000. So you're waiting for a couple of $100, but you're missing out on thousands of dollars in equity. And so that's
And
what
do the
we're trying to
math.
make sure that they understand. And look, at the end of the day, if it just doesn't work for them, that's fine. But I want to make sure, in conjunction with our partnership with you, that we make sure everybody knows what both scenarios look like. And so that's why we talk about if you can do it now, the upside is greater because of the equity, because there's only been one, in history, there's only been, one recession really where, property values dropped. And that was as a direct correlation to when, in 08, 09, when they were just giving money away, not unlike the way Fed, was giving money away during COVID, but that's a little bit different situation. But we're facing the ramifications of that now, and that's part of what we're dealing with.
But to
So
your point, you just said, average say 2 or 3%, and we're seeing over in some cases 10%. But let's just split the difference and say if it's 3% average and it's 6% now, there's a 3% gap there, right? Are the interest rates 3%? Or do you think they're going to come down 3%? No, you're not going to get 3%. So really, you're getting that money. You're just getting it in equity position as opposed to, in cash in hand. So it's intangible versus tangible. And I think a lot of people don't realize that and say, okay, well, even if the rate's 8%, well, factor in the extra 3% of equity that you're getting in appreciation. So you're really kind of paying 5%. So talk to anybody that invests in any kind of other investment and says, well, if I'm getting a 5% return, that's, guaranteed that it's only going to improve, or on top of the normal appreciation that I'm getting. Well, then what's going on there? So like looking at it from that perspective and saying, okay, getting in now, getting the equity, allowing that to start to, again, the investment to work for you. Your payments is part of the investment, rather than going, hey, I'm going to invest in a rental property and pay rent at 100% interest, where I get absolutely nothing in that year that I'm waiting to buy a house. Instead of calling Chris now and I'm going to go pay this elevated, rental cost, I'm getting nothing out of it. But meanwhile, if I go over here, I could get a 6% return on what I did. And in the meantime, lower my payments as the market allows me to.
yeah, and there's definitely a lot of advantage, and we're going to touch on that here shortly. But I want to switch gears slightly. Same kind of concept. We just talked about, how can we help folks that can actually afford that payment and qualify for the house with that rate. But let's switch over a little bit to the next buyer, which is the person that rate actually pushes them out of the affordability. And it may not seem like a lot, but to a lot of people, 1% difference in a rate on a house can be the difference, between being able to qualify and not, and afford that
Mm-hmm.
payment and not. So let's focus on them for a second. So, you know, the people that are in that situation, I know we have to do some things on our end, but structurally from the mortgage standpoint and structuring the deal, what are some of the things that we can do as a partnership to help that person if they want to tap into that equity and get in that house now? What are some of the things that we can do for those
And I
folks?
think the big thing on that is what is holding them back from the affordability, right? Is it just a situation where the market, their job, they're this or that, or is it that they have a lot of debt?
Yeah.
And you brought this up a minute ago, and this does speak to what's happening. If you look at the historic trends right now, people are carrying a lot higher balances on credit cards. They're buying it because what happened was we had all of this supplemental income being dumped into the market, right? Everybody was getting a check from the federal government, and they were living high on the hog, going, "Hey, I got $800 this week, and I got a month later, I got $600." And they were spending that money, which is what the government wanted them to do. But the problem was they learned to live like that money was always going to stay there. And then when the money stopped, they kept living like that money was going to keep coming in.
Yeah, it becomes
So
a habit for sure.
the question is, are they outside of that box debt wise, let's say debt ratio wise, because they're still living a COVID lifestyle or a
Mhm.
supplemental income lifestyle? So that's the first question. Are you just spending too much? Is it time to really buckle the belt and sit down and say, what are you spending your money on? Where is it at? What's going on with that? So that's one, situation. The other situation I'll run into right now is because mortgage lending has gotten a little tighter on what we call variable income. So it's people that work an hourly wage instead of a salary job, and the way they're calculating the income has kind of limited what they're really bringing home versus what's considered qualifying income. So then the question is, okay, let's look at that. Is it a situation where I have clients that say, well, I can do overtime if I choose to, or I can work up to 40 hours, but I'm only required to work 36. So you start looking at those things and saying, okay, well, what's the most important thing to you? Is it owning a home? Is it that, you could work those extra 4 hours, you've just chosen not to over, say, the last 6 months. Well, if you've go back into that and consistently do that, maybe that changes the income calculation, and maybe that does make them qualifiable on it. Again, the last thing is going back to that budget. If you truly are serious about the investment of home ownership, then you have to be willing to sit down and look at a hard look at what you're spending your money on a day-to-day basis. And maybe it means you got to give up that Starbucks, every, two a day for every single day, every single month, and start looking at it and make some concessions in order for you to get into the home sooner than later. Well, outside of that, down payment assistance programs, and then we'll get into some program things here in a minute. But looking at those, would those help them get to the point where they can qualify for this amount of a loan? Well, they don't have enough to get to the purchase price. Well, can we utilize some of those products to get them available and eligible for it? And then lastly is a cosigner option, an availability. Is that a discussion that anyone has had with someone that said, yes, you know what, we will help you step in to get that equity. And then when those rates come back, we refinance, we'll remove ourselves out of the transaction. You now own the house free and clear. So those are a lot of different ways you can do it. But a lot of things I think that comes down to is sitting with a mortgage professional or even a financial advisor, if you have one and you have assets, and utilizing those things, and saying, how can I make this work? And that really, I think the number one thing, though, is you have to commit to it. You have to commit that I want to make home ownership a priority for me. And whether that's January 1, whether that's today, whether that's, next year, whatever.
So while we're kind of in this pocket, just wanted to touch on one thing, real quick. There's a lot of stuff floating around, 2-1 buy downs, various different buy downs. So just to clarify, because we're talking about a couple different buyers, is that are those buy downs? Yes, we can do those with anybody, but in terms of how it relates to qualifying for the mortgage, does that help, that buyer that can't qualify right now, or is it strictly going to probably benefit the person that can stomach it? But hey, maybe we can get them a better rate temporarily until hopefully the rates come down.
Correct. So good point. The temporary buy downs that you're mentioning, the 3-2-1 buy downs, 2-1 buy downs, 1-0 buy downs, they won't help you qualify. You have to qualify off of whatever the rate is at the end of that temporary period. Now, a permanent buy down, yes, whatever you buy the rate down to permanently, that can be used to reduce the debt ratio to qualify for a loan. Okay, so there are ways to utilize buying down, but those are permanent buy downs. The 2-1 buy downs and the 1-0 buy downs, and even the 3-2-1 buy downs, those are temporary, and the qualifying of the borrower has to be done on the worst case scenario. That's more for your buyer that says, you know what, I love this house. It's been on the market a little while. Maybe they're willing to give me some concessions and pay for some of this. And I'm going to give myself a little bit better of a situation while I wait for that interest, or while I wait for those markets to come back to fruition, or come back to center, or come back to reality, whatever you want to say. And at that point, that's how you're using it. The permanent buy downs can be used to help those folks that an interest rate is too high for them to qualify. But the temporaries will not solve that
solution. So let's stick there for just a second on the permanent buy down. Is that certainly we can structure the deal possibly get the seller to contribute towards that. What about, somebody maybe that does have that family member, can someone gift money that goes towards a permanent buy down? Is that an option?
Absolutely. Gift funds from a borrower's family, depending on programs, each have a little bit of a distinction on. Usually, it's a direct family relative. Most of the time, either blood relative or step parents or something of that nature. But that can actually be used for anything. It can be used for closing costs. It can be used for buy downs. And based on the program, depending on what program they're looking at, they're all going to have limits on how much, on certain things that they're going to want. Most of the programs these days will allow you to get gifts from anybody, or up to anything. The only restrictions you have on what the seller concessions could be. So if a seller says, "Hey, Chris, I'll go ahead and give you X amount of dollars towards this transaction," well, we just got to make sure that X amount of dollars doesn't, exceed the amount of concessions that are allowed. But as far as gift funds, if you got a family member that says, "Hey, I really want to see you in this house, and you need to get that rate down to X in order to qualify, and I can gift you those funds." Absolutely, we can certainly utilize that as help.
All right. Well, so let's you mentioned closing costs. So let's talk a minute for that. So we've talked about the two different buyers in terms of, the rate sensitivity. Well, let's put that aside for a second. Maybe that's not an issue for the next buyer that we're talking about. Maybe their issue is, I'm not sure if I have enough money sitting in my bank account to, go to a closing table and have that money, basically to get in the house with the closing costs, the down payment, things like that. So what are some of the strategies and products available, stuff that you're seeing now that you can help that situation for that buyer, try and go to the closing table with little to no money down out of their pocket and still get in the house?
A couple ways that could be approached depending on the borrower, right? So you have programs like the VA loans, which allow for 100% financing on the loan, which means any funds can just be, so they don't have a true down payment. They just have to deal with closing costs. USDA, same thing. Now, there are some restrictions. Obviously, the VA, you have to have served in the military. A USDA, the property has to be located in a certain area. So if you take those out of the equation, there's a couple, the down payment assistance programs through the North Carolina House Finance Agency is another great one right now. Depending on your income, that can be as much as $15,000, towards the down payment and or closing costs, whatever you need it for. So that's a great way to get somebody into a transaction. And that loan can be, that down payment assistance can be piggybacked with an FHA or VA or USDA. So there are ways to get into that kind of program with, as you said, little to no investment, on the borrower side. Sure, the programs do have restrictions. There's income caps and things like that because they want to make sure these funds are available for folks that need it, not that just want to take advantage of it. But at the end of the day, that's a great program that helps them get to, that. And I think you had a question too coming up about, programs that are out there. One of the other ones that has come up now, and it's actually through a group of Indian tribal council that is come out, and it's a very similar concept, but it's a piggyback FHA loan, meaning that you have an FHA loan for a first loan, and then they offer a second loan that you actually make payments on, where the NCHFA you don't make payments on. This one you make payments on. It's a great opportunity for another option out there because that's a 3.5% second lien. So you're essentially creating 100% financing between those two programs or between those two loans. And then you're only realizing what you need to deal with on the closing cost side. So that's another way to do it. I would also challenge people when discussing things about, do I have enough money? A lot of people just think about what's in their checking account, savings account, money market, whatever. If you've been working on the same job for a while, I would challenge you to look into some of your retirement accounts that you have. A lot of retirement programs allow for them to access funds out of a retirement 401k and put it into an acquisition of a property. again, you're taking the investment from one thing and putting it into another investment. So at the end of the day, you're not taking that money out and going out and spending it shopping. You're putting it into equity, a house that house is going to then generate for you. So those are some ways that people can look at, getting into something with the least amount of funds possible. And again, it just depends on each individual situation and where they're looking property wise and things of that nature.
And so that's a pretty good segue, I guess, into, one of the next questions I wanted to ask is, let's talk about, you know, buying versus renting. Um, I think, you know, on the very front surface, everybody kind of knows, okay, the difference between buying and renting. But I think what gets lost in that conversation a lot of times is what advantages on the back end does actually owning your own house and the equity that spins off of that
Yep.
provide you in terms of opportunities to build your wealth and build a portfolio. I mean, you look at it. I mean, if you look at the the conglomerate of millionaires in America, 95% of them built their wealth on real estate.
Yep.
And, I think I think people don't often get explained to how you can, you don't just have to have a lot of money sitting around and go invest and flip properties and buy this and buy that. You know, you start small. And the best way to start that is through home ownership and
Right.
the equity because, I got two bags of cash in my hand. Well, if I'm renting, guess what? 100% of that's going over to the landlord and I never see it again.
Yep.
But if I take that same bag of cash and I own a home and I pay that to my mortgage, well, guess what? Pretty good chunk of that every month, and it grows as you longer you stay in the house. But that actually goes back almost into like a savings account for yourself, and it's called equity.
Mhm.
And you can tap into that equity and you can do other stuff. I mean, I know this from personal experience. We were, we've been able to take, I say our family has been able to take money out of, our property and put it into others to grow and have other opportunities in investing. And it just kind of snowballs from there. So, you know, let's, I guess, and maybe I stole your thunder there about what you're going to say, but just want to let you touch on that because you see a lot of the products, I guess, or equity things and things that people actually do with their equity
Yeah.
in real life and what they're buying. So I'm going to kind of be quiet for a second and
Well,
let
you
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 kind of
hit
touch on
you
that.
hit, you hit a lot of the key points, right? It's 100% interest on a rental property, right? And every dollar that goes out, nothing gets returned. So let's just use you said you buy a $300,000 house. Let's just say a 3% return. In 3 years, you have $27,000 of equity generated just on a basic, appreciation on the home. Well, that doesn't include the fact that for 3 years you also made payments, so you've now built even more equity. Plus, you have some. I'm not an accountant, but there's some taxable benefits as well of owning real estate. So you have that to kind of add to the kitty of everything. So at the end of 3 years, you're looking at $27,000 to $35,000 of available, I'm going to say it again, air investment improved, over that time frame versus 3 years of renting. And you look around and say, I got to start all over. There's nothing. I'm not getting any money back from the landlord. I'm not getting any my security deposit. Maybe if you're lucky, But at that point, you're not getting anything for living in that. Yes, you've got shelter. That's great. You need that, but you don't have any. You're not. It's not an investment.
Yeah.
A rental is being in a rental is fun. It's necessary. You have to have a place to live. I get that. But you're not investing in yourself. You're not investing in your surroundings. You're jumping over to owning a property. Now you're investing in something that's not just today, tomorrow, every day that you write that, every month that you write that check, you are putting, as you said, forcing money into essentially a savings to yourself. And I've, watched that. And then again, I know you had some other questions on that. Like, what are these people doing with it? And, we can wait on that question or jump into it now. But you have something that you can do, with that money now. You can, Chris and I, we've talked about this numerous times, and we don't see it as much as I think we used to in in real estate. a lot of people are trying to jump to the forever house, like right off the bat, instead of saying what it always used to be was you get into the starter home, you do some things, maybe some updates, you do this, you build the equity, and then you sell that house, you take that money, you move up to the next move up buyer, move up borrower, to that next house. And, a lot of these people that are sitting there and they look at what other people have, or they say, oh my gosh, how could they afford this house? That's, this. Well, they typically didn't just jump into it. We of all people know in our region how many people we have coming down here, retiring down here. Well, they're coming down here with those bags of money, and those weren't bags of money that were sitting in the bank. Those bags of money were created by exactly what you just said. They invested years ago in real estate in the home that they're in. They've sold that home now. They're coming down to our region with this large amount of money that they received from the equity they worked hard to get. And they're able to get this forever house and retirement house that's, $1 million on the water, whatever it may be, right? Yeah. So it wasn't just them sitting there this whole time with that money sitting in the bank. So
yeah. And I kind of use this analogy sometimes. I mean, if I were to go out today and sign a 3-year lease on a rental property, and let's say it's $2,500 a month, which is pretty probably median, around here, rental rate. Well, if I sign that 3-year deal, guess what? In 3 years, I'm going to have given that landlord $90,000, and I have nothing to show for it. So that right there, that statement, you can do the buying side of that, and now you've put in that $90,000, and you've got two ways to grow your money. The equity that you're paying in, now that money that you're paying in, that $90,000, you're getting a good chunk of that back in the form of equity. But guess what? While you're getting that equity, we've talked about those prices, home prices, the equity in that growing up. So now you've got a bigger gap. So you're growing your money two different ways. Mm-hmm. So, I mean, what other investment can you do that? Mm-hmm. And so, that's why when we stress, buying versus renting, it's because we've seen it firsthand and the opportunities that it affords people. So it's not just, oh, we want to sell another house. Yeah, I'd love to sell you another house, but I want to see you build your wealth and get that $1 million house or whatever your dream house is. And the easiest and quickest way to do that is to go ahead and get in a home, build that equity through your payments, build that equity through growth and value increasing. And now, like you said, now you've got this pocket of equity that you can roll into the next property, probably paying close to the same thing you were because of that equity. And now you eventually get to that dream home. And so there's, or you start investing, you take some of that equity and maybe you're happy in the home that you want.
Yeah, there's that word
a lot
again.
of different ways to do it.
Invest.
Yeah. So, I mean, it's, there are a lot of benefits that I think people just maybe miss sight of when we start talking about that. They think on the front end,
it's the tangible immediate versus the intangible thing that you can't see, yeah. And that's, I think, where a lot of people get so enamored with the rate, the payment, they forget about all the things that you don't see behind the scenes, because everybody knows what comes in their bank account and goes out of their bank account. But I know I do, but I'll look at my bank, my mortgage statement, and I say, oh, great. I'm looking at, I love watching that thing come, the balance come down and know that the value is going up. And I'm sitting there going, that's just, that's the best investment I've had, Right. We can't control the stock market, and we can't to some level control the real estate market either, but it's not the same as it was years ago, where as you said, there was just so many things that shouldn't have been done happening, where people were getting over 100% financing. None of that stuff exists anymore. So now, the stability of the real estate market is even stronger than it was. So when you say, okay, I'm going to buy into this piece of dirt and this house sitting on that piece of dirt, assuming that I keep it in good condition and I, do what I need to do and do, make sure I do my normal maintenance, whatever else, I have an asset that I know I can sell. Unlike a car that you drove off the lot, and immediately lost money the moment you drove out.
For sure. So let's talk real quick. Again, we're sitting here in October, November and December, everybody kind of gets into holiday mode. But let's speak directly to that buyer that maybe has a goal of trying to figure out a way to buy something starting, the first of 2024 or in the spring or whatever. So these next 2 months, November and December, while we're not really super active in a bunch of houses coming on the market or going out to see a bunch of houses, what would you tell that person that, for the next 60 days, like what are some of the things that they need to really focus in on to put themselves in the best position to say, all right, come January, I'm so much better now than I was, sitting here in October when I was talking to these guys.
It's really sitting down and going back to that idea of, okay, if you're going to make the commitment to that this is your goal, this is you're going to invest in a home in say 2024. It goes back to that. All right, sit down and really take a look at the budget, take a look at verifying, where does my income look like, talk with myself or somebody else in mortgage industry. Is there a tax return that's going to be coming up? How to utilize that tax return refund if they're consistently I usually get back X amount of dollars. It should be the same this year. Sit down with someone and say, okay, how is the best way to leverage those things? And, if there's an issue on the credit report that maybe that needs to be handled, and that's going to get you where you need to be because your credit score is not quite there. Or, again, do you realize how much you're spending on a month-to-month basis on things that aren't necessary, that are just for, that are things that you want, not need? And don't overspend in the holidays. I mean, that's probably one of the bigger ones too. Is like, you don't have to have, for some of those that know the movie, the Clark Griswold Christmas every single year. You can, if your commitment to the investment of a home in 2024 is there, then you're going to have to just reel it in a little bit and say, hey, everybody, this is the deal. Everyone's going to be capped. I'm not spending more than this amount on such and such, and everybody's getting this, and call it a day. And most friends and family are going to say, hey, that's awesome, Chris. That's so great. You're going to buy a house in 2024. They're not going to complain that they didn't get a fancy Christmas present from you, because they're going to be happy for you and for your decision on what you're doing. So again, goes back to go back to the idea of budgeting, see where you're spending your money, making sure that you're doing the right things that are going to be a positive and put you in a position that you want to be at the end of two months. Be cautious of what you're spending over these. It's really easy to overspend at the holidays and do this and do that. Set yourself a budget, write however you do it on your phone, this, that, whatever you want to do. There's plenty of apps out there that you can use. Mint's got a free one out there that you can link everything to, and it'll warn you what you did over the course of a month. Utilize those tools. You don't have to sit there and spend thousands upon thousands of dollars to have somebody write a budget for you. You can use a lot of free tools that are out there. See what's going to happen again with that, the funds that are coming in. What is that tax return if you're getting one? What is it should be used for? Should I use it for down payment? Should I use it to resolve some credit issues? Should I just save it? So that kind of thing. So, and speaking with somebody that like myself or someone in the industry that's going to look at the programs that are available to you, so that you are preparing yourself for the best case scenario. Because I know I can do it, and I've done it already. I do a lot of to be determined approvals for people. So we're not necessarily ready to buy right this second, but we're going in and saying, well, let's just make sure everything is good to go, have it underwritten, they look great, or if there's anything that comes up, they know what exactly they have to do to fix before they go into the open market and start putting houses under contract.
Oh, all right. So we're going to switch gears for just a second. You know, again, we're talking mortgages, things like that, but I want to switch to somebody that already actually owns a home. We touched a minute ago on the benefits of somebody that owns a home, what they can do. So let's talk about that for a second. And, what are you seeing, the people that, did make that leap of faith, and now they got a lot, there's a lot of Americans now that are sitting on a lot of equity because in the last 3 years, property values have gone up. So now they've got that equity, and it can either sit in the home or they can tap into it and use it for stuff. So what are you seeing on that side that I guess savvy homeowners and investors are using to kind of, to their advantage to do some things they want to do?
I would say probably the top three things that people are using equity for. One would be going back to that idea that people got themselves a little deeper in credit debt than they wanted to. And with these interest rates, impacting the credit card markets, some of them are going and consolidating those high interest debts, and utilizing that to get everything under one payment, knock it out, and get it more under control. Instead of having, I got 5 credit cards at the X amount of dollars, I'm going to consolidate it to one payment, home equity loan, home equity line, that kind of thing, and get those things off my back so that I can get out of credit card debt or high interest debt. And it doesn't have to be credit card, but anything that is a high interest debt. Second would be going back to your idea of the fact that the ones that are sitting on these low interest rates from COVID, they don't want to touch the second mortgages. They don't want to buy another house because they're just concerned about it. So they're deciding and taking that equity out, and they're improving the property that they have, knowing that in the long term, that's going to mean better return for them when they do want to get a bigger house or upgrade or change or whatever. So they're spending that money on the kitchen renovation, the bathroom renovation, or maybe even talking to you and saying, Chris, I'm not really ready to buy now, but if you were to list my house, what were some things you would say I should do or I should spend my money on? And a real estate professional like yourself can tell them, well, this is what you should do, this is what you should spend money on, this is what you shouldn't.
Right.
And they'll come in, maybe it's a detached garage, maybe it's maybe it's a fence, maybe whatever it may be, utilizing that equity for improvements on their existing property, because they're not ready to make that leap to a different property because of rates right now. And then lastly would be using that equity to acquire other property. That's, people are looking at it and, maybe it's a situation where they're coming in and they're like, what, I don't like the rates, but I have so much equity, I could buy this house in cash. Well, there you go. So that's I'm going to go and buy that condo at, wherever, and Airbnb it and this, that, and the other. And now they have passive income from that investment, and the interest rates don't matter to them because they're not, they're following those. It's already part of their equity, and they're just, utilizing it in a different form. So those would be probably the top 3 that I see with what people are doing with the equity, depending on how much they have accessible to them.
Sounds good. So new mortgage products, is there anything out there that's come recently that we need to be aware of, or, whether it's that first time home buyer or maybe it's an investor, that there's a new product out? I know I've been hearing some stuff about, some multifamily stuff coming out and things like that. So I know there's stuff, people are always, trying to come up with new stuff, but, obviously I'm not the loan officer. I want to always hear those things from you. So what are you seeing that's coming about that you think will be a good
from
product
my
for
front,
somebody?
the one I'll tell you, like I said, that's an interesting, kind of a spin-off of that down payment assistance kind of idea. If you can't make that work, because those programs do have pretty tight debt ratios, that we call it Arrive Home. There's other companies have a different name for it, but that piggyback FHA first and second combination thing, that's a program that's out now that I think is it's got some merit. It has some hurdles. It has some things that you got to meet the criteria, you got to fit into the boxes. But I would say that one is one product that to put on the radar. You mentioned the other one, it would be the change to multi-unit loan to values. So for those who don't know on this video, loan to value, how much you're borrowing versus how much you're putting down. So if you're doing 5% down, it's a 95% loan to value. So a 1 and 2 unit, 2 unit properties would used to be capped at 85% loan to value, meaning you had to have 15% down, are now at 5% down requirements. So if you can find a duplex, that you want to get into, you only have to put 5% into it versus the 15% you used to. And they've also increased the 3 to 4 unit ones, which used to be 75%. Now they're 85%. So, we significant change there to anybody that's looking for property, which, you spoke a little bit about, the idea of or looking at buying a property and maybe building up equity and whatnot. That's a great way, honestly. If you can find one, if you can find a 2 unit property, live in one side and rent the other. So FHA allows you to do that. So if it's your primary, you have to live in one side, you can actually, utilize some, income from the other property or the other side. So that's helpful as well. And then the last thing coming up, which happens every year, is the change to the loan level price, the maximum loan amounts. So conventional or conforming loans, as of right now, are 726,200 was the previous. They are about to announce. They usually announce it late November. What it officially will be for 2024, but I know Fairway has already launched that will accept conventional loans that's up to $750,000, as of today. So, which means that it'll probably be higher than that going into next year. So, why does that matter? Again, we didn't talk too much about this because we were talking about more people getting in and out of the market, but jumbo loans are a completely different animal. So they have a lot more requirements, more down payments. You have to have more cash. You have to have reserves. A lot of these things that don't have to happen when you're in a conforming loan size. So with the prices going up, the ability to do a loan at a higher amount is also going to be helpful for some folks because they might have all the parts and pieces, but they just maybe don't have enough to get it down to $726,000. And that would open up a door for them to buy this house. So this could give people an opportunity to get into that home that's, let's say, 800,000 that they really want, but they just don't meet all of the extra criteria that are required by jumbo loans. So that's another piece that's coming down the pipe.
Cool. So yeah, we've talked, in this roughly 45 minutes, I guess, that we've been on, a lot of different things. I know it kind of just, we haven't explained everything, but trying to touch on a wide variety of things that we're seeing, people are asking us questions on. So hopefully, some of what we've talked about today resonates with you, makes sense. But I know a lot of you will probably have questions after watching this. So Kevin, let me just ask you, for somebody that wants to buy a home or whatever we've talked about today, but they're not sure where to start. What's the best thing for them to do right now to kind of start the conversation with you and put a plan together?
Really, give me a call at any time, 910-465-2414. You can take a look at be on the website, kevinmillermortgages.com. But get up with a loan officer like myself. Really, put down an application. We have the ability to do a soft credit pull. So for those that are concerned about, I don't want my credit hit and dinged, well, we don't have to. We can look at what's called a soft inquiry, which has no negative impact to your credit score, but it allows us to look at the report and see if there's challenges that we have to address together. So getting that kind of laid out and being able to, get a game plan together and look at, okay, where is the income? Where are the assets coming from? There are a lot of programs, and there's a lot of programs that have a lot of little quirks and unique things that you need to look at. So adding that ability to go in and do a soft credit pull and really put down a loan application and go through all the programs someone's available or could have available to them in the future is the number one thing to start, and if they want to expedite that, as I mentioned, we can turn around and go to the next level and do a to be determined, fully underwritten file for somebody so that there's no always looking at the phone and worried every night that, is it going to happen? Is it going to happen? We have the ability to do that. And it also obviously gives you a better opportunity to work with Chris or your team when they're going out to somebody saying, hey, I'm ready to put an offer in on this. And I didn't just get pre-approved. I got fully underwritten. I'm ready to go. So as long as that house is going to, appraise and everything's in line the way it's supposed to, we're ready to rock and roll.
Well, that's the thing. I mean, I think especially right now, this time of year, going ahead and reaching out to Kevin, and saying, okay, here, where do I stand? What do I need to do? Because, unless you just have an immediate need and you have to buy right now, you're probably not going to really start that process of looking at homes probably until January at the earliest. So what that gives us the ability to do is to identify, like you said, anything that might be a challenge so that we can go ahead and have 60 days to figure out what is the game plan to remedy that, or maybe just, if nothing else, put you in a better spot to maybe get your credit score, a couple points higher to get you a better rate, whatever the case may be.
Or
if we don't know, we
self-employed.
can't help you. Yeah, exactly. Or yeah, you got a lot of paperwork that's got to be done and you're not just a straight W-2. because I can't tell you how many people just call us and want to go see houses. And I'm like, well, have you seen anybody, talked to anybody? And now we got our pants on fire and we're trying to figure it out. So, have we pulled it off? Yes, but it's a better situation for you if you go in prepared, have a little time to get yourself in the best position to buy the right house and get the right deal and get the best mortgage. And so that's really the advantage of going ahead and starting that process now.
And it takes a lot of the stress out too, because if you know that the financing is, you've got it, you understand it, you have it laid out, it takes that piece out so that you can go and, be with Chris or one of your team members out looking at properties, and you feel confident about going into that contract. You're not going, oh, I don't know. Again, I hope it works out. I hope this is, you already know all of those ducks are in a row. So you can focus on that one thing. Does this house meet the criteria? Does it have the things that we need? Can we utilize this investment to where we want to go in 2, 3, 5, 7 years? So, the numbers part is my side where I want everybody to know they have 100%, 150% confidence in, yep, this is the right program. This is the right payment. I know exactly what's going to happen. Now I can go out with Chris's team or Chris, and I can go look at that house and just sheerly focus on the house and focus on it. Does it do what we needed to do? Or, I'm not worried about, oh, well, that's $2,000 more than a number I thought I had in my head. So now I got to figure out something, and nobody wants to do that. It's one of the reasons why I'm sure you as most agents, you need your clients to look and speak with lenders, because you don't want to go out, look at a property that they have no way of affording and then turn around, because nobody wants to see the $500,000 house and then find out they can only buy a $200,000 house. And when you look at those in real life, there's a big difference,
Yeah, very big. For sure. Well, cool. Well, Kevin, I appreciate you jumping on with us today.
Thanks, sir.
Great information. Like I said, hopefully this little bit of information helped some of you that may have questions. But if you do have more questions, or something that we said spurred some questions that you need to ask, certainly reach out to either one of us. I'll answer what I can, but if it's more mortgage specific, we'll definitely get Kevin plugged in and get you the answers that you need there. But again, we work as a team. It's very vital. I won't get on a soapbox, but to have a great lender like Kevin as part of our team, because we have to work in tandem to get the best deal and to get contracts. Because when you're in a competing environment, we have to put you in the best light to get that deal. And that's where the partnership between agent and lender plays a vital role in getting you what you want in a house. So we really appreciate Kevin and all he does for our clients. If he says you're good, you're good. And that's the thing. We know that's why we deal local, and it helps us. And I got somebody I can go to if I have a problem. So again, thanks for everything that you do, Kevin, for our clients and for our team. And so you guys reach out to us, and we'll be happy to get you plugged into the right person to get the questions answered that you need. And hopefully everybody has a happy holiday, but start thinking about that house for next year. And we hope to hear from you soon. All right.
Thanks
Thanks,
again,
Kevin.
Chris. Appreciate it. Appreciate your team.
Yes, sir. Thank you.